Welcome everyone. Hi, I'm Bob Kendall. Don't forget to subscribe, click that bell, and share these videos. Once again, we start another week off on a downtick. We saw huge volatility with the futures opening 5% on Sunday night. It recovered somewhat. We still were finishing much lower on the session, but there seemed to be some air of stability. On the news today was the Fed coming in and going nuclear. It reminds me a lot of what happened in Japan as they went all the way to the extreme of buying individual securities to the point where they own 70% of the equity markets. Can that happen here? I'm not sure. But the Fed is involved in every market now. They are trying to save this country. And meanwhile, as I've discussed, you can't shut off the cash flows in the country and expect it to work. You look at the Treasury Secretary talking about these trillions of dollars in stimulus. It's not going to work. You can't shut off the income and then plug the hole with $6 trillion and expect everything to get better. And most importantly, what they're trying to do is influence us to put money back into the market. And that's not going to happen, especially since we don't know what's happening yet. There's rumors that they're going to shut down air travel now. All non-essential air travel will get shut down in the United States of America. Think about what's going on here. This is pretty ridiculous. I have been very vocal, especially on my Twitter account, that this is probably the worst decision that's ever been made by any administration. I don't know why they're doing these things and why they're so drastic. I'm still not buying in to the level that this coronavirus is capable of. For instance, H1N1, by the way, remember swine flu? That's what that is. 20,000 dead already. No one talks about that at all. But the point is that they're shutting the country down. They're shutting down the cash flows. I talked to you yesterday about the annuities and the risk in the annuities. And this is going to continue to be a major focus of mine because all of the banks, the brokerage firms, mutual fund companies, and now insurance companies are going to be in play. And the reason why the annuities are such a big subject for me is all of the cash flows. Insurance companies own bonds and equities, but more bonds because they're interested in that income. And even if they hedge the downside, it doesn't change the outlook. Who knows what happens with insurance premiums? I talked about last night that probably 30 to 50% of the cash flow in this country is being shut down right now. This is just catastrophic. And there's no way to recover from something like this. You don't put $6 trillion in, flip a switch, and everything's okay. The other thing that you saw today around the Fed is you saw the reaction where the Dow Jones went up 400 and dropped 1,000 points and down 600. And it settled down weaker on the session. We are seeing some overnight strength. I'll unpack that here in a few minutes. But this is not over. I keep telling everybody, don't expect to see an instant bottom, a V bottom. There's a lot of downward pressure here, and there's nowhere to go, and there's no reason for this thing to rally. As I've been saying, we still don't know the impact of what's happening. It's just happening. Really, the big impact has been over the last 2 weeks. These decisions that are being made are catastrophic. There's no way out of this thing now. So all we can hope for is that they don't go completely stupid on us and try to shut the market down for a week to calm it down or something like that. That will just create unbelievable panic. And if they telegraph that, people will panic selling out of it. As I've talked about before, customers of our firm, you should be in cash now. You should not have any exposure. Don't fall into the fears of FOMO, the fear of missing out, because the only thing you're going to miss out is on the downside. I continue to suggest you stay in cash, stay calm, and stay safe. That's going to be the best way to handle this crisis. So let's take a look at the technicals and see what kind of clues we can find there. Looking at the S&P 500 daily chart, you can see we've continued this downward surge. PPM1 continues to be down sharply at 1.99, PPM2 minus 1.85 and minus 0.86. So this trend is not over. We could see some stability. We are seeing about a 3.5% move overnight on the futures, setting up an inside day. The 10-period moving average is going to continue to be a major resistance point on the futures. That's 24.36, about 150 handles above where we're trading right now. If we can stay above 21.91 on the cash, we're likely to see minor bottom set up, maybe a consolidation trading as high as around 24.50. It's going to take at least 3 to 5 sessions of stability to start to have the PPM start to flatten out and signal some possibilities of rallying back to 2600 plus. The volatility is not likely to calm down anytime soon as the machines continue to run most of the activity, and there's still a lot of illiquidity. There's a lot of volume, but the spreads have widened, and that's one of the key elements in this market that's causing all of the volatility are the spreads. There's plenty of buying, even though yesterday volume was down 16.64%. We were down to 7.5 billion. This should be moving back towards the 6 billion level. We start to see volume slow down multiple days, then we'll probably see the market start to stabilize and see some upside. If the low of 21.91 is taken out, then the next level is 21.60 to 21.42. My expectation is that it will hold. There's only 40% probability that that low will hold at this time. Looking at the treasuries, the 10-year did decline pretty sharply yesterday, back to 0.76. I talked about this possibility. We should hold here on the 10-year, and we start to see a move back toward 0.9 to 0.95, with the possibilities going back to 1%. But there should be some stability in these yields, and they start to move higher as the market stabilizes. One of the surprises that came out of yesterday was the sharp rally in gold. It did move sharply higher. I talked about getting up to around the 1570. We're following through again tonight. We're at 1598, almost back at 1600. So this is really positive. There's still a lot of resistance here, and my expectation is around 1605. We should see some resistance here, some consolidation, but this is a good sign that we're back above the 200-day moving average and possibly setting up a larger pattern. It didn't look like, looking at things over the last several days, that we would see it move this high, but there was definitely a lot of interest that came in, and most of that was because of the perception of what the Fed is doing is potentially extremely inflationary. I've discussed in the past that anything the Fed does will cause more concerns. It's not going to make things better, and certainly all of the activity they have in announcing new QE programs and everything they've done is starting to really wake up the concept of inflation going forward. Thanks for watching, everyone. We'll talk to you again tomorrow night. And remember, remain in cash, stay safe. Talk to you soon. Don't forget to subscribe, click the bell, and share these videos.